We do believe there's serious demand destruction taking place at these price levels.
Cathie Wood, in a recent interview, said that the correlation between equities and crypto is one method to identify a bear market, and that it may even indicate the beginning of the end. She also believes the Federal Reserve will not hike interest rates by 0.50% in June. She also said that her firm Ark Invest is exercising prudence in the aftermath of the Terra fiasco. But the bottom line was that she thinks we'll get out of the bear market soon. If you want to know when exactly we could get out of the bear market according to Cathie Wood, then watch this video till the end, and don't forget to press the like button. Also, subscribe to our channel for daily updates. We post twice every single day. Now, let's look at her interview.
So let's start with monetary policy. So in the last month, the Fed did tighten up. We are now in the Fed funds range between 0.75% and 1%. So from basically 0 to 25%, we have, or 25 basis points, we've now gone, if you use the high end of that range, from 25 basis points to effectively 1. So up fourfold. And the reason I'm giving that as perspective is we are beginning to wonder if one of the policy mistakes here is not understanding that we're starting with interest rates at such a low base that when you quadruple them or go up tenfold, which many people think the Fed will do before all is said and done. So going from 0.25% to 2.5%, that's a 225 basis point increase. That's up tenfold. We've already gone up fourfold. And just hearkening back to the last time the Fed was fighting inflation and ferociously fighting inflation was under Volcker in the late 70s and the early 80s. And I was there. I was just starting my career. And I remember the Fed funds rate was at 10%. And Chairman Volcker at the time jacked it up to 20% in one move. So that was up 1,000 basis points, to be sure. That's a lot. And he did it to shock the economy. But that was only up twofold. We've already gone up fourfold and potentially up tenfold. And just beginning to wonder if, the impact on the economy, starting from such a low rate and having been at low rates for so long, that maybe this is, yes, a shock to the economy. And we're seeing M2 growth slowing. It peaked, I think, at about 27% and is now down to 8% on a year-over-year basis. But if you look at month to month, what you'll find is money has barely grown at all since January. That is very tight policy already. And now we're beginning, I think just yesterday, we began something called quantitative tightening. Now, I say we, it's the Fed started quantitative tightening. And what that means is that it is going to let some of the assets on its balance sheet simply roll off. It's not going to buy mortgage bonds or treasury bonds as it has been, just to replace those maturing. Many people think that quantitative tightening is a real tightening move. I think I just described the tightening moves. The quantitative tightening is nothing more than assets on the central bank's balance sheet, the Fed's balance sheet, that are going to roll off. They were kindling for what could have been an accelerated rate of bank loan growth, but they were never lit. And so they're simply going to roll off. So we don't think that is as significant as the actual tightening moves as it pertains to interest rate and money supply. Now, one of the fights, or the biggest fight that the Fed has on its hands, it believes, is inflation. And inflation has been much higher than we would have expected. And you know the reason. Supply chain issues for much longer, almost 2 years now, more than 2 years now. And then, of course, Russia invading Ukraine, really driving up food and energy prices. So the Fed is not happy with this, and no one's happy. In fact, the consumer is very upset, hasn't been this upset since 08, 09. But we are beginning to see signs that inflation has peaked. And Chairman Powell did say maybe it did peak in March. We got the personal consumption deflator, which is the Fed's primary inflation indicator. It's the one they pay to which they pay the most attention. The headline PCE deflator was an increase of 0.2%. So that's 2.5% at an annualized rate, roughly. And if we were back there on a year-over-year basis, the Fed would not be tightening. Nonetheless, to see that happening at the margin is really important, and the Fed should start taking some comfort from it. The core CPI, it pays more attention to the core CPI, was up 0.3%. So that's 3.5% annualized. It would like to get that down to 0.2 as well. But we have seen the year-over-year inflation rate in core PCE drop from 5.3% in February. So this measure of inflation peaked perhaps in February. March was a tick down to 5.2, and April down to 4.9. And if those sequential numbers are any indication, that rate will continue to come down over the next year or so. So the other prices that the Fed is watching, I think, are copper. Copper is a very good indicator of what's going on in the economy. And that's the global economy. We know that Europe and China are practically in recession, if not absolutely in recession. China's easing to try and take some of the pressure off. But I think oil prices might be the more important price, mostly because of how they impact consumer sentiment and inflation psychology generally. So oil prices did kick up this last month again. We still didn't get back to the peak right after Russia invaded Ukraine. Oil prices got into the 130s per barrel. And we're now down to 119, but we have been down below 100 very recently. So it's kicking back up, and it will influence the inflation metrics. Not so much the core PCE, because core excludes food and energy. And this metric was, I guess it was designed or derived in the 70s when oil and food were very, very volatile and often misleading in terms of where inflation ultimately was going to go. So we shall see what happens. Oil is influenced by a cartel. We do believe there's serious demand destruction taking place at these price levels. You can see around your own communities, there's either less traffic or that you'll see more bicycles, scooters, and so forth. And we do believe, and we've been saying this for some time, that oil demand globally probably peaked in 2019. It is the supply shock that is driving prices up, and is also going to, or has accelerated the consumer preference for electric vehicles over gas-powered vehicles. So we do believe that this oil price increase is sowing the seeds of its own demise in the form of demand destruction. And when we say oil demand peaked in 2019, we mean it peaked. Many people used to use this concept, peak oil, when they were talking about supply, thinking we'd run out of it. Instead, we are using it in the form of peak demand, the demand destruction and the shift towards energy conservation in all kinds of ways. For the first time in Bitcoin's history, we've seen 9 consecutive weekly declines. And so when we first looked at that, I think the tendency was to say, uh-oh, that's really negative. My question to the team was, well, could it be oversold? Could the rubber band be stretching here? Or is there something wrong? And we don't know the answer to that. So we put that in neutral category. And you'll see we'll put each of these metrics in bullish, bearish, or neutral. But we do know what happened in the last month is that Terra, the blockchain Terra, blew up, and Luna is worthless. I think I'm correct in saying that that the market cap of that ecosystem at one point was around $60 billion, with a lot of well-known advocates for it. I was surprised because algorithmic stablecoins don't make any sense to me. I have a background in economics, and I think you need the backing of something in order to have a stablecoin, and this did not. And so it didn't surprise me to see the number. I think this is the number of Luna outstanding go from in the span of a week, something like 350 million to 6.5 trillion. And I think it maybe even got to 20 trillion. So that's hyperinflation. There was nothing backing it. And I can say we would never have touched it. Nonetheless, that turmoil, that it didn't create a systemic risk. And we've been paying attention to the other stable coins out there. Are they going to so-called break the buck? So that expression came about after the reserve fund, a money market fund during 0809, broke the buck. People holding that money market fund were going to get less than $1 back for every dollar they put in. And of course, the Fed had to come and rescue that fund, because that was going to become systemic.